Welcome, and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In this show, we cover a broad range of topics that both cater to CRE newcomers and industry leaders alike. I'm your host, Ryan Schlesinger, Director of Revenue Operations at Crexi, a comprehensive digital commercial real estate platform designed to empower CRE real estate professionals with the tools they need to discover and transact property. Today, we are lucky to sit down with David Wheeler and Anthony Trollope of Hartman REIT and discuss their 2022 outlook on investing in office properties. David serves as Executive Vice President and Chief Investment Officer for both Hartman Income REIT Management and Hartman Advisors. David has over 30 years experience in the sales, acquisition, disposition, financing, and leasing of commercial real estate investments, and leads the company's capital markets activities, including acquisition, financing, and disposition programs totaling over $1 billion in transaction activity, $1 billion in transaction activity. Anthony is Hartman's Director of Interactive Marketing and has more than 15 years of digital marketing experience. Before joining Hartman, Anthony was the Director of Digital Marketing and part of the senior leadership team at AMID, a Houston, Texas-based company specializing in medical devices. He oversaw a seven-figure digital ad budget, led the marketing team, and oversaw operations across web strategy, search marketing, social media, and content marketing. David, Anthony, thank you so much for joining us today. We're really looking forward to this.
Great to be here, Ryan. Thanks for the invitation. Enjoy the opportunity to share some thoughts with you. And one more thing about Anthony, he's an real award winner. Friday, he got the company's highest award from the founder. He got the CEO award. He's been with the firm about a year and made some really significant transformations to the way our marketing team works, and the level of achievement in that department is just tremendous.
Amazing. Well, Anthony, congratulations. I'm glad you chose the Crexi Podcast as your first, media outlet after your big award. So thank you for that.
Yeah, thank you. Thanks, Ryan, and thanks, David, for that introduction. Appreciate it.
So I'm especially excited to have two guests like yourselves on this show today, because we have David, who obviously comes from the investment side, who's seen it all, and I would love to hear about your experience at CBRE and how that translated over to Hartman. And then Anthony, I think you really bring the other side of what Crexi does, which is the marketing piece and what marketing looks like in commercial real estate. So maybe, David, I'll start with you, but maybe take us through the story of how you got to Hartman and how you fell into real estate and what brings you here today.
Yeah, thanks, Ryan. So coming out of college, I had a civil engineering degree with construction management option, allowed me to take some business courses. So I hired on with a general contractor doing basically site work, horizontal construction, some people refer to it as. And one of the early assignments with that firm was on a business park in Plano. Ross Perot Sr., founder of EDS, had acquired 2,600 acres in West Plano in 1979. And in 1983, when I was with HB Zachary, we landed the contract to do all the initial infrastructure in a business park that's now known as Legacy. It's if you're familiar with that name, it's where Toyota has relocated their domestic headquarters, their U.S. headquarters. It's where JCPenney built their headquarters. So it really took off over the last 3 decades. But that was my introduction into real estate, and I was rubbing elbows with the executives at Electronic Data Systems who were overseeing that development project, and that was really my kind of entry into the real estate business and my fascination with them and what they were doing in terms of overseeing us as a contractor was really what drove my interest in commercial real estate.
That's very interesting. So you literally started from the ground up working
there you go.
in prepping these sites. So you start out on the engineering side, you're working really in the nitty-gritty of details. How did you get from being an engineer over to the brokerage side?
Yeah, great question. So before I left undergraduate school, I had put a lot of thought into what I was going to do for my future and realized that I wanted to go back and study business more in depth and planned on going back and studying business at the graduate level before I left my undergraduate. I got two pieces of advice. One was to go work full time for a while before you go back to school, and the other was to go and when you went back to graduate school for an MBA, go ahead and quit and go back full time for school. I think a number of these executives had seen people try the part-time MBA program and all the way through it. But
sure.
I knew before I left I was going to get an MBA, and that's what I did. I worked for H. Zachary for a couple of years. Went back to SMU and got an MBA there with a concentration in real estate. That allowed me to change industries, change my profession, and that was my entry to what at the time was Caldwell Banker Commercial, a Sears subsidiary, which is now known as CBRE, and where I landed on the regional staff for a couple of years, and then went into investment property sales for 14 years.
Excellent. So once you found yourself at CB, you're working in investment sales for 14 years. Did you have a market focus or a asset type focus? Or did you start out on a team with some mentors, or were you kind of set out on your own?
I did have great mentors. It's a good question because when I joined the firm in '86, here specifically here in Texas and at some level across the nation, there were some things going on that were really shaking the foundations of the commercial real estate industry. You had the 1986 tax law change. You had the S&L debacle, and here specifically in Texas, you had oil trending down into the mid-teens. So all of that created a real significant impact on the commercial real estate business. A lot of properties went back to lenders. The state was "quote unquote" redlined for a while, so finding debt capital was difficult, and values were kind of being chased down for a really substantial number of years from '86 to about '91. It was difficult for people to make investments in Texas, difficult for them to justify them, and sellers were struggling with how to deal with the market and mark their assets to market. So I wound up working on kind of whatever I could at the time. There was an intention of going into the industrial sector, but where you noticed a lot of the opportunity in the late '80s was in other areas. It was in office, or it was at shopping centers, or even in land, to work with these lenders that had taken back properties and needed to bring them back out to market and sell them. So I wound up kind of working across functional lines and working on a lot of different property types. By the time I had been in the business 5 or 6 years, I'd worked on office projects, shopping centers, land, self-storage, really quite a number of things, even a little bit of industrial, which is where I sort of started the business.
Yeah, that's very, very interesting. And I think it's important, especially for a lot of young people in commercial real estate. Like, for example, I had a pretty quick career where I've really only seen kind of the real estate cycle from 2014 to now, where we probably, until COVID, you really didn't see that many shocks in the way you're describing, where capital was especially challenging. And for the most part, depending on the asset class, sellers and buyers weren't really having those kind of mark-to-market bid-ask spreads. So I think it's very interesting. I definitely want to come back to that, but I think that actually dovetails nicely into Anthony's side of the business a little bit. So Anthony, maybe give us a little background on where you started, and then how your marketing career drove you more to the real estate side.
Sure. Yeah, absolutely. I mean, I spent my 15 years or so building a business out of college, an online business, digital business. Did pretty well with it. It was an online business connecting wholesalers and retailers with one another. It's an online community, and it had a marketplace attached to it. And I actually managed to achieve a good exit to a private equity firm before I moved here to the US. Here in Houston, I met my wife and got married and moved over here. So that kind of led me into working for a couple of other people, into the W-2 world. And personally, I've always been interested in real estate. Mostly from its wealth building and in investing and orientation, but clearly it's proven itself a very tangible asset, with very dependable returns. And I think that's important in an increasingly fragmented and digital world. What excites me the most, and one of the primary reasons why I joined Hartman, was for the ability to be part of this digital transformation. Real estate in particular is still a very old-fashioned industry. A lot of traditional methods of doing business, particularly on the marketing side. I think we're really in the early stages of digital transformation and digital adoption compared to a lot of other industries. And it really excites me to be part of such a mammoth industry that's going through such a rapid change. It's very disruptive. It's very fast moving times for real estate, particularly on the commercial side. And with things like prop tech, Internet of Things, cybersecurity, and now even things like blockchain, which is an even more intriguing prospect for us. Those are just some of the reasons that kind of got me interested in a marketing role within real estate.
I think that's a perfect kind of a perfect bridge into what David was talking about a little bit as well. So I kind of want to pivot back. So David, it's kind of the mid 80s. There's a lot of different fundamentals that are presenting some challenges. Anthony alluded to how we're still sort of in the first inning of a digital revolution of how we market and transact real estate. Take us back to what sourcing buyers or even finding listings to represent. What did that process look like for you in the 80s, and how did that evolve while you were at CB?
Yeah, the virtually everything was paper, printed, and using the phone. At the time in the late 80s and early 90s, there were a few of us that had PCs with software on our PC to help us kind of track our contacts and maintain a database of contacts. But it was a lot of phone work. Email hadn't really taken off, and virtually everything that you worked on or processed was printed paper. It's everything's being printed out, and construction and marketing materials is it's pretty cumbersome. We're trying to do as much of it in the house as possible, and therefore it's not only less sophisticated, but it's probably much lower quality than what you'd see today for many reasons. But there's some real challenges there. But that training in terms of making lots of phone calls and connecting with lots of people was great. It was tremendous. CB did a really good job of explaining how to cold call, how to farm a market, how to develop a market. I spent a lot of time driving neighborhoods and areas. In fact, one of the first things they asked me to do was drive all the industrial properties in Dallas County.
Wow.
And it took me about 6 months to not only cold call, the hundreds of folks that they wanted me to call, but to literally drive all the industrial areas and kind of look at all the properties. So, but it was great training, being out in the field, seeing the properties, at eyeball level and good stuff. I would tell people that Google Earth and all these technologies we use today are really valuable. They help tremendously, especially if you're remote and you can't get to a property.
Sure.
There's nothing like driving the neighborhood and walking the property in person.
Yeah, I just remember when you come across a lot of leasing brokers, a lot of people or a lot of them would say, I never had any software that would tell me where someone was located. I could walk a block and tell you who leased every floor of every building in our CBD. Mm-hmm. So I totally hear you on that one. I think, Anthony, one thing about marketing in real estate, especially on the investor side, the buyer side, something that can be interesting is that you really have a number of different customers that you're trying to market to, depending on what function, right? Raising money to buy, looking for people to purchase your assets, looking for people to do a number of different things. How do you, who do you see sort of as your target customer? I guess where, David in his past life as a broker, you're really prospecting for people to let you represent their assets and then looking for buyers for them. But right. On the REIT side, Anthony, where would you say where is your team focusing their strategy? Who are you trying to reach?
Yeah, we're seeing a lot more direct deals just coming out of the pandemic. Less broker representation, just because these deals are a little bit smaller, but also people can kind of realize that they can negotiate directly with the landlord. In our case, get some good deals going. So it depends on the venue, and it depends on the property. We have certain assets in our portfolio that lend themselves more to direct deals and more and less so broker deals, and we have some properties that are in heavy broker driven markets that tend to come with broker representation. Our tenant mix is particularly geared towards smaller businesses, and that's actually helped us through the pandemic because we don't have a massive exposure to large corporate tenants, particularly as most of our assets are in that B kind of class of property. But back to your original question of how do we target them, we use platforms like Crexi to hit both brokers, but also, we know that tenants are using, the platform themselves to find great deals, great leasing deals as well. So I don't necessarily know, we do certain deals that we gear towards brokers, certain incentives that would appeal to them, as we do for obviously tenants as well. But most of the narrative, most of the content that we create is pretty applicable to both targets.
Absolutely. No, that's super helpful, and I think creates an understanding of where marketing within your sector can kind of be targeted towards. So David, coming back to you, your past in brokerage, I always think that having a background in brokerage allows you to just see so many iterations of how a real estate deal can go and can create incredible experience for the future. So you go from brokerage to obviously going on to that buy side. What was that transition like? Did it feel seamless based on your background? I guess talk us through that move.
Yeah, it was somewhat seamless. Brokerage is a great investment property sales is a great background for acquisitions work.
Mm-hmm.
And that's where I really started my career with Hartman, is focusing on acquisitions early on. It's kind of the agent of expansion here in DFW. We didn't own anything outside of Houston at the time.
Sure.
So I would tell you that 95% of what I knew at CB in terms of the markets and how they worked and how to look at a property and how to analyze it all played into my acquisitions work here at Hartman. The secret sauce at Hartman was about learning the investment philosophy here, how to get things done internally, and why one deal was better than another in terms of the buying strategy, here. So, that took a little while, but, as somebody who'd been in the business for, 16 years, it really didn't take long. It was a relatively seamless transition.
Got it. And so sorry, remind me again, when did you start at Hartman?
The beginning of 2003.
Okay. Wow. So almost 2 decades at Hartman now. How, you've obviously seen a lot of swings, a lot of different cycles there in your time. I guess, what are some of the huge differences between what your day-to-day is like now versus what it was earlier in your tenure there?
Well, so I started out really just focusing on acquisitions. Over time, my territory grew, and then I took over the department, and our department responsibilities grew. So we took on a little bit of disposition work. We took on debt sourcing. We took on tax protesting.
Wow.
We spent a lot of time over the last 5 or 6 years talking to investment bankers about a potential IPO. I coordinated our investment banking activity, which thankfully played into some of our debt sourcing. One of our biggest pieces of debt was sourced through Goldman and an investment banking relationships that we have there. So the role really expanded fairly dramatically over the years. And acquisition is still a cornerstone of what myself and my team do. But we also do some financial planning and analysis work, kind of corporate level analytical work, and other sort of modeling and special projects as well. So it's a significantly broader role, a significantly bigger company, and a more forward-thinking company than it was at the time, obviously. So
sure. And so, Anthony, now how many years have you been with Hartman?
So I've been here for nearly 16 months, I suppose. So not too long, and
sure.
Providing just strategic growth and leadership on the marketing side. But one thing to mention about Hartman is we're vertically integrated in a sense that we sort of control every aspect of our business. We've leasing's in-house, property management's in-house, construction, marketing obviously is in-house, and Dave's team on the acquisition side, and we also have an investment sales division. So So I'm leading all the marketing efforts on both sides of the business function, the management company and the investment sales division of the REIT.
Got it.
Which really means that I'm responsible for finding new prospects and generating leads, to fill up vacancies in our buildings, and then helping also with the investment sales team so that they can continue to raise capital, which we then recycle back into acquiring more assets that fits Dave's team's profile, a buying profile.
Sure. And I think there's going to be a influx of more people with your background coming into real estate companies, right? As real estate starts to adapt to a lot of the digital marketing strategies that other companies have used. Granted, you're still probably learning a lot and absorbing a lot about not just the real estate industry, but more specifically your markets and Dallas and Houston, et cetera. I guess, how's that learning curve been? And, what have you done to sort of know enough to execute in that marketing role? Or would you say that there's a good kind of separation of specialties that allow you guys to be successful there?
Yeah, I mean, good question. I think it helps to have folks like Dave, who's been in the industry for 30, 40 years, to lean into them and ask them what their opinion is, and surround yourselves with them and conversations that they're having. We do a lot of activity on the thought leadership side. So we put folks like Dave and others in our company on a bit of a pedestal. Really, we put them out there and say, look, we know what we're talking about. We've been in the industry a long time, and we've got some thoughts and opinions and insights. And so obviously, being surrounded by those, I tend to pick things up pretty quickly. The marketing side comes a little bit more naturally to me. I kind of know what I'm doing in that realm. And as I said, we're going through a really great digital transformation inside real estate. So real estate is behind the curve, and Hartman, is still a little bit behind the curve, in terms of its digital presence. And we're obviously, that's an opportunity, one that I relished when I came into the role. But it also just gives you a sense of the magnitude of what's possible here over the next 5+ years as we bring this transformational cycle to reality.
Yeah, no, I think a lot of that makes sense and is definitely helpful to hear. I mean, David, I'll kind of last point on Hartman at a high level. I guess how as someone who's seen probably everything you can in this industry, what has sort of the digital transformation or the marketing impact, how has that helped or mitigate challenges that you've seen in the last couple of years?
Yeah, I think what Anthony's talking about and what he's been able to achieve here over the last 14, 16 months, however long it's been, has really been tremendous. He inherited a couple of folks on the marketing team and really accelerated what they were doing and added additional staff. And, marketing to tenants, marketing to investors, and creating opportunities for the rest of us to get out in front of the industry and bringing organization to that and structure to that has been really tremendous. They've been great collaborators and brainstormers on new ideas and ways to get us exposure, and way to create that exposure in a way that really explains the story, the way it should be explained. So I'm really impressed, and I think it's been well beyond just about anybody's expectations on the platform.
That's great to hear. I think that's the CEO award speaks for itself. So I think that all adds up. So I want to shift gears here a little bit, and I kind of want to talk more about what you guys are doing every day, which is mostly how investment thesis, trends, market analysis. Correct me if I'm missing anything here, but we kind of kicked off the call. Your portfolio is across Texas, majority of which is office, and then the other portions being retail, mostly shopping centers and some industrial as well. Just high level, as someone who's by no means a Texas market expert, I think you guys are in an especially unique situation where you've seen the office climate change and there'd be a lot of pivoting to remote work or a hybrid model. which would maybe hamper office footprints. At the same time, Texas has been one of the biggest migration points for businesses in the country. So you've sort of had these two conflicting fundamentals going, where some would favor office, some may change the outlook of office. But I guess at the high level, for those who aren't as familiar with Texas, what are you guys seeing in the office market? I'll start there with David, probably, to kick that off.
Sure. The one of the most interesting things I noticed was pretty recent, probably 4 months ago or so. I was looking through the data that our leasing team now puts out. We've got a couple of folks that really produce some much more elaborate reports than what we used to review. And one of the things I noticed was half of our leasing activity through half of the year was being generated by tenants that were like 3,000 square feet and below. And it's relatively consistent with the story that we've observed over the last year and a half. After the initial shutdown last year and the reopening of offices, what you noticed was the smaller tenants started to come back quickly. They didn't necessarily have HR departments or legal departments that were driving decisions to stay remote.
Got it.
Or real concerns. So you saw them come back to the office quickly. You saw office utilization drive up quicker. If you're looking at the Castle data, Austin, Houston, and DFW have led the nation since they started tracking it or kind of putting it out there during the pandemic all along. And they've been way ahead of the rest of the country. So those folks were decisive in coming back to the office. Therefore, you would expect them to be decisive on renewals, new deals, seeking space.
Sure.
And our program of providing a lot of move-in ready suites was really paying big dividends over the last year and a half, as tenants, mostly smaller tenants, were primarily the ones being decisive. We're looking for those move-in ready suites. They're not interested in looking at a space that might take 3 to 5 months to build out. They're ready to go. It's time to move now or within a month, and you really don't have a lot of time to do construction. So that's one of the big trends I would tell you is a lot of the activity has been in small tenant space, and a lot of it's been for those tenants that are looking for move-in ready suites.
David, I thought that was a really, really helpful kind of outline of who the target tenant was and sort of what they were looking for. So Anthony, if I'm assuming sort of that probably became the heart of maybe messaging in a lot of your marketing materials, did you have to sort of alter the channels you would use or go after a different audience based on the fundamentals you were seeing?
Yeah, we did. For a large part of my role when I first joined here in the last summer, we were in the heat of the pandemic, and one of my first assignments was producing a piece of collateral that helped not only our property management teams articulate the benefits of being in the office to tenants, but also provide the employers, our tenants, with the reasons why folks should be working from the office. And so we developed a lot of research and insights, and we went out and got all that and put it all together in a piece of collateral. And that was really our messaging. We were in the trenches just helping people not only navigate the pandemic safely, but where they could and where possible, do it from the office, because that's the business that we're in.
Right. And I think another piece that was kind of a hot button topic when it came to office was the whole suburban versus central business district, keeping in mind smaller tenants, becoming more of the focus. But were those folks looking for different types of geographical locations, or sort of same separation as all tenants?
Yeah, I think a lot of Class A buildings have suffered because they're predominantly located in CBDs. So that's why cities like NYC, San Francisco, Boston, and the such have been so impacted by the pandemic. Folks want to be closer to their homes, and one pronounced trend that is going to persist is this flight to suburbia. The pandemic has led to people really reevaluating quality of life, and the tolerance of long commutes, it probably isn't, and the appetite to have those continue probably isn't there moving forward. So that benefits us because our buildings are not in CBDs. They're out in suburbia, and that's where we like to be, and that's where we like to invest, and that's where we see the value over the next couple of years, certainly. So I don't think that trend is going to go anywhere. Another thing that I'll mention, since a lot of our buildings are class B, I think we only have maybe one to three that are actually class A. Our occupancy rates have held up much better than most. We do have a couple of corporate tenants that are occupying large full floors, and some of those maybe haven't returned quite yet. But fortunately, most of our business, as they've said, is geared towards the smaller tenants. So, these are folks that don't have large international office footprints with a dilemma over, which group of employees to bring back and when to bring them back and how to handle hybrid work schedules and so forth. I mean, a lot of that is still being figured out. And we thought Labor Day was going to be the big return for offices, and some folks pushed it back. Some people have come back, and it just varies. We really haven't seen a great deal of that. Not only because we're here in Texas and we have a pro business state, and certainly are without getting political, some of the stance that is adopted here is looser than other states,
sure.
for sure,
yeah,
which has definitely benefited us. But on the smaller tenant side as well, these are much smaller businesses with fewer employees and less complicated circumstances to deal with.
So David, Anthony, I think gave a nice capture of the tenant and velocity side, leasing side. How has this maybe impacted your investment thesis or buyer strategy, in the last 30 or 18-ish months? Any transactions you can point to that were dramatically impacted by these shifting fundamentals?
Not so much from our standpoint, because we've always been oriented towards suburban B and a lot of smaller tenant properties. We're just reaping the benefits on a comparative basis when you look at the CBD and the fact that that's a lot more corporate environment. And Anthony was pointing out a lot of the differences. The other one I would point out is when you're in the suburbs, you're not only closer to home, you're probably not taking mass transit to get to work. Whereas if you're the CBD,
totally.
it might be rail or whatever to get
sure.
there. So we're just reaping the benefits in terms of rising occupancy this year and tenant demand and being able to source tenants for our properties.
Sure. Would you say you were uniquely positioned, since this has been your bread and butter for a long time? Did it give you maybe a bit of a jump start to already have inroads with a lot of these owners, a lot of the players in the space, whereas maybe some of these larger groups or people from out of state that probably were looking to move their portfolio allocation to Texas? Did that kind of give you a bit of a jump start on the competition?
Yeah, it does. And really the reason we have a bigger jump start is when you're talking about suburban B that might be $10 million to $30 or $40 million in value and might have a small tenant orientation to it, those are what I would call operator assets. And our model is property management, leasing, or internal. I think if you're coming from out of state, you don't already have a portfolio in one of the major Texas markets, it's hard to figure out how to get your arms around that suburban B asset that has a lot of granularity to the role. Whereas in our case, we've got the machine built. There's operational teams providing white glove service.
The assumptions.
We know the assumptions. We know how to service those properties. We know how to get our arms around them and execute on them quickly. And I think that's a bit intimidating for investors that are coming from out of state. That whole process of how do we deal with 100 tenants in a 200,000 or 300,000 square foot project, which we have sometimes. Those are kind of the outer limits in terms of small tenant basis, but those are challenging assets to operate, and you need the right staff. You need to already be there in terms of staff to make that happen well.
And I think what you just covered there on the execution side outlines a big difference, because something you would read about in the Wall Street Journal and a number of other publications was on the residential side, you would see people from other markets be bidding up the price on houses, 125% of what the list price was. But to your point, because you don't have that operational infrastructure on the CRE side, my guess would be you wouldn't see that quite as much. Did you see any deals kind of go haywire because a player from out of state maybe came in and said, we just got to be in Dallas, Houston, Austin because of what's happening there, and we're willing to get a little more aggressive? Or were they shying away from it because they said, this is not a place we're comfortable, we don't know it well enough?
A little bit more shying away. It does seem like, when we pursue an asset, it's still more local and regional competition, or it's folks from out of state that either already own assets here or investing through a local company.
Mm-hmm. How about same sentiment, Anthony, maybe more on that leasing side? Have you seen a lot of tenants that weren't local before that may be looking to grow a presence in Texas come? I know on the suburban side, maybe a little trickier, but I guess what does the inflow outflow look like from a leasing perspective?
Yeah, we're definitely seeing a lot of inquiries from out of state, particularly in California is the obvious one. I can't think of any deals in particular, but, we do have a lot of people moving here, and some people are moving here with their businesses.
Sure.
So we would definitely service them. We've definitely had some interest from corporate relocations as well, coming out of California and other places to Texas. And obviously we're always excited to see those levels of inquiries, and for them to choose a brand like Hartman would be big for us.
Sure. So considering what we just talked about, I think we got a really nice capture of what's happened over the last few months here. Looking forward, understanding some large fundamental things, which I know are impacting different pockets differently, but rising inflation, the market doing what it's doing. How do you see sort of those macroeconomic levers impacting occupancy rates and tenant retention? And are you guys, is that something that's maybe impacting your decision making now, or something you guys are looking at as we go into next year?
I would say that in inflation expectations and this whole discussion around transitory inflation, is it transitory? Is it just transitory? Is it transitory for longer? Is it, what's structural inflation going to look like? Tends to play more into a capital markets discussion and the way people price the debt and the equity more than operational trends like retention and even rent rates. In the long term, I think it has the potential to play into rent rates. The other thing I would tell you is in terms of the energy space, with the turnaround in oil, we're starting to see employment, growth around the energy industry. So that's kind of a green shoot, so to speak, as a result of a current economic trend. But the inflation expectations, inflation trends really influence our capital markets discussions and our thought process on debt primarily. The timing of the sourcing of debt, which whether go floater or long-term fixed debt equations more than anything else.
Got it. And so have you started to adjust your strategy there yet, or is that still sort of a wait and see?
No, we're kind of in the middle of that right now. We're in the middle of sourcing some additional refinance opportunities right now, and we expect that we will be moving from less short-term floating to more longer-term fixed as we move forward.
Mm-hmm. And speaking more through, obviously we just covered, I think, how your debt strategy is changing a little bit, which was influenced a lot by inflation and interest rate expectations. As far as and granted, expecting anything to come out of a Congress is always a wait and see. But from an infrastructure side, you touched on the energy sector, which obviously Texas is a big piece of your economy. Is that something that you guys are giving any sort of confidence in and thinking that you can expect a big boost from infrastructure spending, or is that not really playing into your plans?
It's really hard to figure out where that's headed right now. If you got a machine and went back, 3, 4, 5 months, a lot of folks expected not only would you have this bipartisan infrastructure package, you would have the social spending package that had gone through reconciliation with just the Democrats, but apparently that process has got kind of sideways. So how that plays out moving forward, we haven't really tried to figure out whether that's going to impact us in any particular way. I think there's obviously concerns about the level of spending at the government level, but
sure,
we're not really thinking that we should be relying on fiscal spending from the government to kind of trends that affect us directly here in Texas, although it's possible that they could moving forward.
Right. No, that's totally fair. I think counting on anything right now in the current political climate is probably not a safe bet in terms of people coming together and making stuff happen. So I think that totally is fair. So as far as, strategies adjusting, and we kind of talked about a lot of what you've done to date, shifting to those smaller tenants, shifting to space that's ready. Is that something you see carrying on through the next 12 months? I think, with especially in Texas, where it's been a big pro-business state, COVID restrictions have been much more lax, which is definitely helping the office market. Does it feel like you guys have been ahead of the curve and are just going to kind of ride that out, or do you feel like there's more adjustments that you're going to make here in your strategy in the next 12 months?
Well, I think we've been ahead of the curve, and I think we're going to double down. I think you'll see us double down as next year move forward, both on the marketing side and on the execution side for delivering those move-in ready suites and for opportunities to secure new tenants and retain tenants. We've also got a number of strategies to rise the retention, to uptick on the retention level amongst tenants. Some of it's economics, some of it's service driven. There's a lot of ways in which we believe we can drive occupancy through drive and retention as we move forward. So that'll be a key focus moving forward as well.
Excellent.
Yeah, I think health and wellness is definitely a trend that's going to persist. Again, we launched needlepoint bipolar ionization technology in several of our buildings, which is, in its simple layman terms, is basically clean air. It's sanitized air piped through the building's HVAC systems. And we were an early adopter of that, and finding and introducing that technology is just one example of how we learned and evolved, throughout the pandemic. And we're just very adaptable in our approach, and we've shown that with, I think, very good resilience throughout the pandemic. I believe we've come out on top. And that's what we've needed to do. We've needed to do that. And I think there will be more focus on clean air, obviously, not just because of this, but I think there's definitely a concern with density kind of going in the opposite direction. What I mean by that is we're seeing a de-densification trend, and I never knew what that term was until Dave kind of introduced me to it probably 12 months ago. And what we're seeing is density being reduced in a lot of our office spaces. So people are having less kind of shared workspaces, and I think the pandemic has probably exacerbated that trend. And we're probably going to see more people move towards private offices and space between desks, and that plays to our strengths again, because from a square footage basis, space is a lot less expensive in suburbia than it is in downtown. So, we can build that flexibility into our leasing requirements. We have the capacity in our buildings to do that, and we have in-house construction that can adjust those floor plates, very quickly if we need to. So those are kind of two trends that I think will definitely continue to gather momentum as we move out of the pandemic.
Got it. No, I think that makes a ton of sense. As far as what's exciting to you, what do you see if big goals for 2022? What you're looking forward to, and one other question is, would you guys ever expand your portfolio outside of Texas, or do you think there's Texas is obviously a beast of a market? There's enough there for you.
Yeah, let me talk a little bit about kind of goals for 2022. The founder is directed that we push for 90% occupancy next year. So there'll be a fair amount of heavy lift, not only the rest of this year, but next year to get there. a lot of operational focus to make sure that happens. And I think we'll see some real significant progress in that regard. So
nice.
I think things are going to be great on the occupancy front moving forward. The question about Texas, we love Texas. I can see us expanding into other Texas markets. We have sourced in places like Phoenix, Denver, Atlanta, Orlando, Tampa. In the past, we like those markets. Those are great, great opportunities. We just haven't found the need to enter those yet. And we do understand that when and if we do expand outside the state, that we'll have to have those boots on the ground operational capabilities to make sure those assets are attended to and run, to kind of the white glove standard that the company provides. So I don't think that's going to happen anytime soon, but I think it's a long-term possibility for sure. I do expect us to expand into other regional markets here, though.
Sure. Makes a lot of sense. I think I kind of want to end on this note with both of you guys on advice, what you kind of tell people that specialize in both of what you do. And I'll start with you, Anthony. I guess, what would you say to a lot of our listeners who are also looking to source tenants for office space, looking to fill space, or how to, what advice would you give to someone who's looking to find buyers for their assets or tenants for their space?
Yeah, it depends on who you speak to. The Class A folks will talk up all the amenities that these buildings offer, and the reality is, not everybody needs or wants a yoga or a Pilates studio with large open spaces.
Right.
And not everybody wants to be downtown, and we aren't in that space. Our assets, as we've talked about today, are in the suburban markets, and we have plentiful tenants that are very happy with a good looking space, with A-class amenities, coffee bars, gaming sections, and we take advantage of our air conditioned spaces, and folks are happy with that. And we also our rates are pretty good. We have a lot of flexibility in a lot of our offerings, and good amenities, good spaces, convenient locations in suburbia. So and as Dave said, we really do specialize in white glove service. We will have multiple touch points with the tenants on a daily basis. We all consider them sacred. In fact, that's one of our core values, is that you keep the tenant that you have, they're sacred. And so we do a lot of things that property management companies don't do out there, and it's the reason that we're so successful with retaining so many of our tenants, is because we really treat them well. So I would say, let us earn your business. We have some great assets, and with service that we don't think you can find anywhere else.
Sure. And David, I guess, pivoting back to you, what advice could you give someone, whether they're in brokerage, on the buy side, looking to make that same move, one of those three? What advice would you give them?
Yeah, a couple of things on the advice side. If you're thinking of this as an investor and you want to buy commercial real estate, think about your niche. Think about what it takes to execute in that niche, and whether you really have the capabilities to do that or not, and how you would foster those capabilities. So you've got to have a very executable plan to make sure that what you're doing works well. And there are lots of different ones out there. There are lots of success across the spectrum in terms of property types, property sizes, et cetera, different MSAs. But make sure you understand how to execute on yours well. On a personal standpoint, I would encourage people to make sure they're developing relationships in the business and doing a great job of networking. I attend at least a couple events a week when I can, to make sure that I'm fostering existing relationships, promoting new relationships, turning up opportunities for the firm, and really creating value through developing a network that really gives us different opportunities across the spectrum. Some of those are vendors, some of those are investors. There's lots of different things you can touch and reach when you're networking that will be beneficial to the firm.
Excellent. I think those are very wise words, and great note to end on. And gentlemen, thank you both for joining us and sharing your insights. I learned a lot, and you guys really cover a lot of dynamics across the spectrum, how commercial real estate is done, and gave me a lot of insights on suburban office and Texas and how all the dynamics work. So I can't tell you how much I appreciate the time.
Thank you, Ryan. Appreciate the opportunity.
Sure.
Thank you very much.
And before I let you guys go, where can people find you if they want to get in touch?
So you can find us at hi-reit.com, hi-reit.com. You can also find us both on LinkedIn. We're both pretty active on LinkedIn, share a lot of our thought leadership and insights and what we think is interesting in the market. So definitely follow us on there. And you can also, if you're interested in investing in Texas, you can go to hartmanreits.com, and learn about our investment sales division there.
Excellent. You won't want to miss that. If today was any precursor, there is a fountain of knowledge from this group. So plenty more where that came from. Thanks to everyone who tuned in today. If you enjoyed this episode, do not miss the next one. Visit go.crexi.com/podcast and sign up to get the next episode delivered straight to your inbox. Of course, you can also subscribe to the Crexi Podcast on your favorite podcast app and check out our YouTube channel for video recordings of each episode. Take care and be sure to tune in next time.